What the heck is happening with our economy? Inflation, it's through the roof. Interest rates, they're going up, and housing prices are out of control. Well, in today's video, I'm going to do my best to explain to you how interest rates, inflation, and housing prices are all interrelated. Now, understand that I am not an economist by any stretch of the imagination, but I do understand the basics. So I'm going to do my best here in this video to help you understand and simplify what's going on in the market today. Hey, my name's Glen Hopkins. I'm a local realtor here in the South Surrey and White Rock area. If you have any real estate related questions, if you're thinking about buying or selling, please feel free to reach out to me. In the description box below, you're going to see a link where you can schedule a call. While you're there, you're also going to see some other links for downloads. You can download my home seller's guide and my home buyer's guide. Also, don't forget to hit the like button, all right? It helps me get these videos out to more people just like yourself. Okay, so let's try and unravel all this and figure out how inflation, interest rates, and home prices are all intertwined. So let's first start off by taking a look at a definition of inflation. Now, I found this definition online, and it simply states that inflation is a decrease in the purchasing power of money, reflected in a general increase in the prices of goods and services in an economy. So to help explain that definition, let's take a look at an example. All right, so let's look at the example of wanting to buy a bicycle. All right, and let's say the bicycle that you want to purchase is $900. So you save up that $900, and it might take you a couple of years to save up that money depending on your financial situation, but you've saved up that money, and the time has come where you want to buy that bike. You go to the store, and lo and behold, the bike now sells for $1,000. It's gone up in price because of inflation. Well, that means that your money, the $900 that you had, can no longer buy the same bike that it once could, say, a year ago. And so your purchasing power has decreased. And just as a side note, in case you were wondering, over the course of the pandemic, bicycle prices have gone up 7%. Now, in a minute, I'm going to explain how this affects housing prices. But first, let's take a look at what actually causes prices to go up and prices to go down. So first, we need to understand the basic principle of supply and demand. Now, again, I am not an economist by any stretch of the imagination, but in simplistic terms, it simply means that when supply is high and demand is low, prices are going to go down. And when supply is low and demand is high, well, prices are going to go up. So let's look at an example again. In the case of bicycles, over the course of the pandemic, the price of bicycles went up. The reason the price of bicycles went up is demand for bicycles went up. So in other words, more and more people were wanting to purchase bicycles, but there weren't enough bicycles in the shop to service all of the people wanting to buy them. So what does the typical store owner do? Well, they begin to raise prices and celebrate. Now, the same thing happened with many, many products and services, including the real estate market or housing. All right. So during the pandemic, we saw a huge increase in the cost of housing. More and more people were buying homes. And because more people were buying homes and there were not enough homes to go around, well, prices went up and they keep going up and up and up, which put us into what was called a seller's market. Now, on the flip side, when supply is really high and demand is low, well, what happens is prices naturally go down, which is exactly what's happening in the housing market today. Because less people are purchasing homes, well, the value of homes are starting to drop, putting us back into what's called a buyer's market. So now you're probably asking, what causes supply and demand to change? Well, to understand that, we have to look to the Bank of Canada. Now, when you think of the Bank of Canada, you want to think of them as being kind of the puppet master of our economy. Their job is not to make money, but rather their job is to keep our economy stable, slowly, gently rising over time. We don't really want to see huge spikes like we have, and we don't want to see huge decreases putting us into a depression. So there are a few ways in which the Bank of Canada can control and manipulate the economy, one of which is interest rates, and another one being just printing more money. And they do this specifically to manipulate the public's spending behaviors. By making us spend our money in certain ways, it dictates basically how businesses are going to price their goods. So again, in simplistic terms, this is how it works. Over the course of the pandemic, the government was concerned that we were going to fall into a recession. They did not want that to happen. So for this very reason, they decreased interest rates. Well, why did they do that? Well, because they wanted people to start borrowing more money, feeling like they had lots of money, and then going out there and spending it. And that's exactly what we did. We were manipulated. And that's okay, because that's their job, to help control our economy and keep it stable from, again, going into a depression or the inflation going up way, way too high. Now, some people may argue that they haven't been doing a very good job of that, but nonetheless, they really do have the ability to control our buying and spending behavior. Okay, so going back to interest rates. So they've dropped the interest rates. People are borrowing more money and they feel, I've got a lot of money, so I'm going to go spend it. And so they go out and they buy, let's say, bicycles again during the pandemic. A lot of people all of a sudden have money and they go and buy bikes. Well, what happens? Well, the store owners, they run out of product. And so they increase their prices, all right? When we look at it with homes, people go out and they start buying homes. But the problem is we don't have enough homes on the market. We have a serious supply issue here in the greater Vancouver area. So when all of a sudden you have a huge influx of buyers, well, you know what happens? Prices go up. And that is what causes inflation. When people want to buy faster than products can be produced. And what's happening now is, well, the Bank of Canada is basically putting the brakes on inflation. And they're doing that, again, by manipulating us. They're increasing the interest rates. And when they increase the interest rates, well, guess what? We can't afford to borrow as much and we can't afford to buy as much. And because of that, it creates a supply and demand issue where we have an oversupply of homes and an undersupply of demand. We don't have enough people with enough money to buy the homes, and therefore housing prices begin to drop. And that's exactly what we're starting to see now. All right, so there you have it. That is my overly simplistic explanation of how interest rates, inflation, and house values are all intertwined. Now, again, I am not an economist, and maybe you're not either, or maybe you are. Either way, if you have a comment, please feel free to share it in the comment section below. Again, my name's Glen Hopkins. I'm a local realtor here in the South Surrey White Rock area. If you have any questions in regards to real estate, please feel free to reach out and connect with me. My contact information is in the description box below.